This is the Angel Next Door podcast, where we will talk about all things angel investing, what it is, who does it, how do we find them, what does it mean to invest in an early stage company. If you have ever wondered how you can affect the change you want to see in the world, then tune in to learn more. In today's episode, I'm joined by Rachel Brink of Red Bite Capital. Rachel has deep experience in the beauty industry, having worked in leadership roles at Elizabeth Arden and Estee Lauder. She was the co-founder and CMO of Scentbird, and she's going to tell us about her journey as an entrepreneur and how that led her to be an angel investor and now have her own venture capital firm. Join us as we demystify angel funds, consumer products, and several commonly used acronyms like CAC and LTV. Enjoy the show. Hi, Rachel. Welcome to the show.
Hi, I'm thrilled to be here.
As you know, with the Angel Next Door, we're talking to people who are angel investors or had become angel investors that really didn't know much about angel investing before they got involved in it, because it's not something that people talk about every day. So let's just get right into it and tell us a little bit about how you found out about what angel investing is and just a little bit about your background.
Sure. So it's interesting because my background, I'm originally from Costa Rica. My dad's an entrepreneur in Latin America. And when I was growing up and seeing my dad build his business, he had a tuna fishing company. And angel investing didn't really exist at the time. I think it just wasn't an avenue. People didn't know how to start businesses, was really just go get a loan at a bank, which is extremely difficult. But as I progressed in my career, I came to the States. I worked in corporate for a long time. I worked for Gillette and did my MBA at Columbia and then Estee Lauder and L'Oreal. But then in 2014, I started a company called Scentbird. And I will tell you that Scentbird's gone on to be extremely successful. We were backed by Combinator. We raised $29 million in venture capital dollars.
Wow.
But at the start, it was really early stage angels that supported our business and helped get Scentbird started. And without the angels, I don't know where it would have gone. So that's really, I got to see the experience of how much impact angels can have in the trajectory of a business. And then for a long time, I was an entrepreneur. I was, heads down, building a business, trying to scale Scentbird. And for me, angel investing happened quite organically, just as an outshoot of advising and helping companies and meeting amazing founders.
That's awesome. So you raised $29 million in venture money for Scentbird. Tell us a little bit about where did you even get started?
So I talked to a lot of founders about, the different options of, you've got to start somewhere. You've got to get from that 0 to 1 is such a critical time for every startup. For us, for Scentbird, we started with a little bit of angel money. There was a man called John Asen, who was a very prolific angel investor here in New York and New Jersey. Unfortunately, he passed away, but he supported a lot of technology companies. He was very supportive of women entrepreneurs. And he gave us, I think, our first angel check. And then we actually went through an accelerator. We were part of ERA, which is a local accelerator here in New York. Fantastic guys. And then had quite a few angel investors from coming out of ERA. And that's really what got us started on the path.
That's great. Wow. I mean, we always hear about how entrepreneurs are trying to find angel funding. And half the time I'm like, you can go to Google and you can see what angel groups are in your backyard, but it's tough. It's a tough way to, kind of connect and network. And then you went on to become a mentor and an advisor to several startups, right?
Yeah. So I think that it depends what type of angel investor you want to be. For me, the way the path to angel investing actually started with first being an advisor and a mentor. And because I was an operator, because I had been at Scentbird sort of from the ground up, from that 0 to 10, and I love working with early stage founders. I love sort of that. How do you get those first customers? How do you think about your revenue model? These are the types of questions that I love helping entrepreneurs with. So it was very organic. It was very much just first was advice, but then frankly, the way I saw it is, it's really an honor to be part of their journey, to have the opportunity to participate in the upside, but also, stay close to the journey, stay close to that early stage where you really see that growth trajectory and you see the seeds of what can become a huge business.
So tell us a little bit about what Scentbird does, and then how did that get you on a path to helping other entrepreneurs, and what types of businesses do you usually tend to gravitate to?
Sure. So Scentbird is a subscription service for fragrances. So basically, you pay $15 a month and you get to pick any fragrance you want. And my role specifically as one of the four founders was on growth and revenue, which is very applicable to the work that I did later on as an angel and advisor. So on the growth side, I like to joke that there isn't a marketing tactic I haven't tried. Paid social, affiliate, podcast, radio, TV, print, subways. A lot of people know us for the subway ads and the Facebook ads. Influencers, we did a lot. And what was really helpful about having such a breadth of experience is that when I talk to founders, my first piece of advice is you do one, two, maybe three things well, but no more than that at the beginning. That's one of the pieces of advice that I always give, right?
That's good advice.
Yeah. And then on the revenue side, it was really around, how do you build a sustainable business model? How do you think about CAC to LTV? How do you think about your unit economics? And for Scentbird, a big piece of that was building partnerships with brands. So we would partner with Coty or Glossier or Macy's. And so that really helped our unit economics. So all those pieces of knowledge were really actionable. And so when I started to work with other founders, a lot of the conversations that I were having were really tactical, right? I need to hire my first CMO. What should I be thinking about? Can I hire somebody to do brand and growth at the same time? How do I run a sweepstakes, right? Like, how do I create an influencer marketing program? So there were a lot of very granular on the ground stuff. And what I thought about a lot and what I still think about is the best founders are extremely smart and they know where they need to go. What they don't know is how do you get from point A to point B, right? And that's where your advice, your knowledge, your kind of granular, well, this is how we did it. These are the specific tools we use can be incredibly, incredibly helpful. So I guess how did I start on the angel side was really, founders kept on introducing me to other founders because they're like, go talk to Rachel. She's helpful on X, Y, and Z. And I started to see businesses that were really, really interesting. And I think what was really interesting to me, people tend to sort of throw me in the D2C CPG bucket very quickly. And while I do invest in some, I always like to joke that I'm probably the toughest angel investor you'll meet in those categories because I actually know how hard it is to build those businesses.
Right.
Unlike a lot of people, I always say, the world is full of beautiful formulas with beautiful packaging and beautiful stories that never go anywhere. And so I do invest a little bit in consumer brands, but there has to be a real competitive moat. There has to be a differentiator. And for me, what's really important is the go-to-market strategy, because to the earlier point about pretty formulas and pretty packaging that just sits on a shelf that doesn't go anywhere. And digital is no exception, right? Like you just create a website and there's crickets. That's not going to help anyone. But a lot of the investing that I'm doing right now, and a lot of what I'm very excited about is I call it what you buy and how we buy. So I think about two categories there. One is e-commerce infrastructure and marketplaces. And then the other one is fintech. So on the go-to-market strategy, I think what's really exciting is if you look at the environment right now, I think it's 1.9 million Shopify vendors, 1.7 million Amazon vendors. And those numbers are from last.
I don't think I realized it was that large.
It's huge. It is huge. And I think those numbers are a couple of months old. So I assure you they're still growing. But what's interesting is this huge influx of online vendors, particularly in the last year with huge growth of e-commerce. They all have incredible needs. So if you think about acquisition, you think about retention, You think about logistics, warehousing, returns, but also, as I was saying, marketplaces. How are people shopping? Okay, great. D2C is one channel, but are there ways to curate those products better? Are there ways where people are shopping differently? For example, one of the categories that I'm very excited about is secondhand. Secondhand shopping is forecasted to grow 11 times faster than regular retail. So one of the companies that I angel invested in is called Queenly, and it's a marketplace for prom wear and formal wear and pageant wear. And one of the reasons I loved it is two amazing female founders that were incredibly capable, but B, it was the idea that like it's a middle America play, right? Like proms don't only happen in New York and San Francisco. In fact, they
Right.
probably happen less. But they're places and they're designers that I may not have heard of, but are incredibly compelling and very expensive. So the fact that you can offer people something that is going to save them money, frankly, be environmentally sound, I thought that was really exciting. So that's one area I get really excited about. And then the second one is fintech, particularly when you think about consumer facing fintech. I actually had somebody challenge me the other day and say, well, you've always been in consumer. What do you know about finance? And Scentbird processed 500,000 transactions monthly. So I think I know a thing or two about transactions and finance. But the other side of it is, for example, one of the companies that I invested in is a credit card company. And the truth is, yes, there is a big part of it that is about how do they do the credit rating, and they have a very unique algorithm that allows them to issue credit cards to students and recent immigrants who may be cash rich but don't have a FICO score, don't have a lot of credit history. But the piece of it is, in the end, they need to acquire customers. In the end, how do you get people to sign on to new credit cards? And by the way, TikTok's working great.
Right, right, right.
So it's interesting, how as you become an investor, it's not only like, oh, well, you've worked in this category, so that's the only, like, you can really apply your learning much more broadly.
Right. And speaking of learning, so here on the show, we do like to demystify some of the things. So you mentioned a couple of our acronyms that we use. So D2C.
So it's interesting. So D2C means direct to consumer. Now, the problem with that term is that in 2014, people were arguing that retail is going to go away and entire companies are going to be built purely on D2C. In fact, Warby Parker was going to be just a D2C brand. What has eventually happened, and by the way, Warby Parker just went public and is doing phenomenally well, is that while e-commerce continues to grow very, very rapidly, it's still only around 15% of commerce. So 85% of transactions are still happening at retail. The point being, a lot of direct-to-consumer brands are now sort of reimagining what it means. So they call it digitally native brands, which you'll also see DNVB. So that's just another acronym to watch out for. But what's happening with a lot of brands is like they're born online, they're born on the internet, but that doesn't mean that they stay there forever.
Right. That's interesting that only 15% is direct to consumer still. Wow.
And what about after a huge growth in 2020, right? Because of COVID.
Right. Right. Okay. What about CPG?
So CPG is consumer packaged goods. So that's a pretty broad category that includes beauty, it includes wellness. Sometimes it includes food, although that's like a whole other subcategory of it. It definitely includes things like household cleaning or toothpaste. So think a lot of packaged stuff that you would see in a supermarket. That's a good way.
I always think of like Procter and Gamble when I think of
exactly.
CAC.
So CAC is cost of acquisition. And there's a lot of questions around what goes into CAC. The simplest way to calculate CAC, and in my book, an accurate one, is you think about all the direct variable expenses that go into acquiring a customer. So maybe it's your Facebook spend, maybe it's the money you spend creating an ad, a print ad or a subway ad, and you divide that by the number of users that you acquired, and that gives you a CAC, which is your cost of acquisition. The reason why it's so important is that, particularly for digital, you're not sitting in a shelf, right? So your main cost while you don't have the retail margin, right? Like if you're sitting in a shelf and you're at a Walmart, you have to pay Walmart about half of your margin so that they let you put your product there, right? Like that's how the business is made and how the retailers make money. When you're a digitally native brand or a D2C brand, the way you get people to come shop is you have to spend money to acquire them. So again, that might be a Facebook ad, that might be a radio ad, that might be a podcast ad. But all those costs, you have to make sure that the business is sort of kept in check because there are some businesses where when you look at their economics, they are probably spending $200 to sell you a $50 product. So that's probably not a very good business, at least unless there's a very good reason why they're doing that in the short term and they have a good reason as to why it will change. But you always have to think about cost of acquisition and sort of the gold standard. Just I always like to share this as a rule of thumb is 3-1. So your gross profit should be about a 3-1 ratio to your cost of acquisition.
Wow, that's great. And that leads to LTV.
Lifetime value. So lifetime value is a really important metric because it calculates not just how much revenue you make the first time you engage with a customer, but over their lifetime, right? Now, the tricky part, particularly when you're investing at the angel stage, is if a company's been around for 3 months, how do they know what the lifetime is if they haven't been around long enough, right? So I think that as angel investors, one of the key things that you need to think about is how loyal do you think these customers are going to be? How long are they going to stick around? Maybe it's a product that has a specific lifetime, right? Maybe it's a baby monitor, right? And so great, but babies grow, right?
Right.
Whereas maybe it's something that you will always continue to use, or even if you're looking at a SaaS platform, one of the reasons investors love SaaS platforms is that enterprises tend to be pretty sticky. Once you've kind of onboarded a vendor and you have them and you're using them, you kind of tend to stick with it. And so the lifetime values for SaaS customers tend to be quite high. At least that's the assumption. It's not always true.
Right. So you've done your own fundraising as an entrepreneur, and you now have your own venture firm, Red by Capital. You are a Latina woman who is out there on the fundraising trail. Tell us a little bit about what that's been like.
So first and foremost, I think people in general, humans, are self-interested. And these are financial endeavors. And I think that don't kid yourself, everybody's out here to make money. And so one of the pieces of advice that I always give founders, particularly female founders, is, it's great to talk about diversity. I think it's extremely important. I think it's important to talk about the impact that you can make as a fund manager. But the truth is, and there's nothing wrong with impact investing. I think that's great, but I'm not an impact investor. The impact that I make is making outstanding returns, right? And so I think that there are sort of realities of where people make assumptions and where they want to throw you and where you want to be sort of controlling the conversation. It's pretty lonely. If you are a female founder and you're pitching venture capital, well, guess what? 97% of it are white guys or Asian guys, a lot of guys. Right. So yeah, I can't tell you how many times as an investor, I will talk to a founder and they're like, oh my God, Rachel, we're so excited to talk to you. You're the first woman we talked to. And at the beginning, it shocked me, but then I'm like, well, no, it's not that shocking if you look at the statistics, right? So you have to get really comfortable pitching to people who don't look like you, who don't have your experience. One of the key things that I think is really helpful is to figure out how to translate your category into something that is very easy for them to understand and that is sort of hard to argue with. So my example is always when we started to pitch Scentbird, we were pitching a lot of white male VCs because, again, that's what there's most of. And they were looking at us like, fragrance, how big is fragrance? Well, my wife always uses the same perfume. Maybe I'll ask my assistant, right? Like they just couldn't get it. And one of the best pieces of advice and how we started to pitch it is we're attacking the fragrance category, which is 21 billion, which is 3 times the size of the blades and razors category. Oh, well, they do shave. So they understood that one.
Right.
And all of a sudden, the conversation changed because they could see the opportunity. So, one thing that I think is really helpful for anybody really is making sure you're kind of giving a framework, anchoring your business within something that the people you are talking to can relate. So that's definitely sort of my number one piece of advice for Latina, for women founders, but really for any founder.
That is an excellent, excellent piece of advice. Let's see, what other types of advice do you have for the entrepreneurs out there that are trying to go fundraise now? They've maybe even taken a little bit of money from friends and family, and they really don't know where their next raise is going to be.
Yeah. So I think that early stage, number one, I think this is a great time to be an entrepreneur. I think there is a lot of money sloshing around. But having said that, I do think that it's a little bit of the have and the have-nots, where you see some founders just raising silly amounts of money with a deck. And I think that's concerning. But you also see great founders in, I will say, more challenging categories. And I would definitely put D2C in that are, really have to work hard to raise the money. So having said that, I think angel groups are great communities and great places for founders to go look for funding. I think the dynamics of it's a little bit different when it's an individual angel and you can connect at a human level. I think angel groups can sometimes get tricky because it's like you literally have to convince 100 people, because if there's one naysayer, it's very easy that they can sort of shift the dynamic for the rest of the group. So I think that's the one thing to watch out for when you're fundraising with angel groups versus fundraising with an individual who's an angel. But I think they can be early supporters. They can move fast. They can help you not only financially, but also, what I've found with angels is they tend to be very personally vested. They want to help. They want to get to know you as a founder, and they can unlock a lot of doors.
And with the rise of funds that are out there, tell us a little bit about what is that landscape looking like?
So it's really interesting right now because particularly when we talk the early stage, which is what we're talking about here, the last couple of weeks, there's been some sort of bombshell announcements about Greycroft and Dreesen and all these big funds doing $500 million seed funds and all these huge funds. But what I see happening, and I'm already seeing it, is that there's a sort of bifurcation of the market, and it becomes the huge funds that are, a lot of them just funding the same type of founders they were founding before, and founders that are sort of curating their cap table and thinking about, okay, these guys just give me a lot of cash, but Red by Capital, it's an operator-led fund. They can actually provide tactical advice. They can actually make the introductions. They can actually help. So we want those types of funds as well. So it's really interesting. I think it's sort of the people in the middle that are having a really hard time deploying capital. But for us, it's so far so good. I think there's some great partners. I think some companies are getting the capital they need to really scale. I think more and more you're going to see these operator-led funds. And I think it's also, angels that have been operators themselves that understand industries can add a lot of value.
Yeah, I'm a huge fan of funds. I think it's a great way to get diversification. And then the fund manager, they have skin in the game too. They're in it with you as the investor. So you got to make sure that you're aligned. And that, to me, a fund is a great way to do that.
It's interesting because I do talk to a lot of, high net worth individuals that maybe did 1 or 2 angel investments. And it's hard. It's hard to be an angel investor. I mean, look, even Andreessen screws up, and like nobody has 100% hit ratio in this industry, because the reality is, 90% of companies go nowhere and 10% of companies do outsized returns and return the fund. So I think what's really interesting when you look at funds versus just individual picking and choosing is you're diversifying risk. For example, in our fund, we're looking to do 20 to 25 companies. So you have a lot more shots at goal. You have a lot more diversification. It's not just this type, it's also e-commerce infrastructure, it's fintech, it's consumer tech. So you have a little bit more diversity, a little bit of a buffer so that you can find the biggest winners, but not be, angel investing is great. And I think there's a lot of positives, but I think, people have to be realistic as well with the risk profile of it.
Agreed. So in our last couple minutes here, we talked a little bit about what your advice is to entrepreneurs. So what is your advice to somebody who's thinking, I think I might like to try angel investing?
So I think that, first of all, I recommend, at least for your first investments, investing in things you actually understand. I think that's really important. It doesn't mean that you have had to have worked specifically in that category, but if you can't get smart, for example, somebody was pitching me something around batteries. I know nothing about batteries, right?
I agree. I don't either.
I talked to a couple of people. The only answer I got is no battery company has successfully exited. It's very risky. You know what? Not for me. So I think that particularly if you're just getting started, take it slow. Somebody told me this at the beginning, and I think it's absolutely true. It's like the first couple of months, you're like, oh my God, I love everything.
Right. You love everything.
Everything is great. And then after a while, you've seen so many, you're like, ugh, I hate everything. And eventually you get a good sort of ratio and you start to become better at filtering and spending time with those founders that make sense for you. So, my advice is start slow, start with things you understand, start with things where you can verify, where you feel really comfortable about the opportunity and look, it's a leap of faith, right? Like early stage companies, you're sort of measuring the smoke signals, right? You're looking
right.
at team, you're looking at category, you're looking at a little bit of traction if you're lucky. But I think that's why it's so important to have a level of intelligence, a level of vetting is extremely important. So that would be my advice, is like, go slow, start with things you really understand, start with things that you can vet with other people. And I do think it's a great thing if you can meet other like-minded individuals that are also angel investing and you can discuss investments. It's really helpful how the large VCs are always talking and are always comparing notes. So I recommend that angels do the same thing.
That makes so much sense. Well, this has been great. Thank you so much, Rachel, for coming on the show and talking to us all about angel investing, your experience as an entrepreneur. You have such a wealth of knowledge, and we are so excited to see everything that's going to happen with Red Bite Capital in the future.
Thank you. Thank you for having me.
Hey, thanks for listening. To connect with me, visit my website at marciadawood.com. And if you're looking to learn more about investing in the changes that you want to see in the world, sign up for Anne and Bill Payne's ACA Angel University classes. You go to angelcapitalassociation.org, all one word, to find out the schedule. Many classes are offered, everything from the angel investing basics, fundamentals, risks, due diligence, term sheets, valuations, returns and portfolio strategy. And for a deeper dive, there are advanced classes which include capitalization tables, startup boards, and exit strategies. If you're not already a member of the Angel Capital Association, you can become one for the low price of $295 for the year, and that will give you unparalleled access to discounts, free webinars with a huge archive of content, networking opportunities, and much more. We'd love to have you join us. All content for this website is informational and not intended to serve as legal, tax, accounting, or investing advice. While Marcia, that's me, does serve on the SEC Small Business Capital Formation Advisory Committee, my views are my own and not the views of the SEC or my fellow colleagues on the committee. Our speakers and hosts are thoughtfully selected for their educational value, but their opinions are their own and do not necessarily represent the views of the host, me, or the Angel Capital Association, and neither specifically endorse the use of presenters' products or services. Listeners of the podcast should consult their own tax, investing, legal, or accounting advisors before making important financial decisions. All warranties, including accuracy, completeness, and suitability for specific purpose, are disclaimed.